MCX presents Institutional Commodity Investing. Media partner CNBC TV 18.
Topic is commodity derivatives shaping the future of alternative investment. I can take this pride in saying that 2025 has been the year for commodities. The year has really changed the whole thought process, where commodities was primarily, or as per the conventional wisdom, commodities was always treated as an asset class which can be used as hedge against your other financial instruments. But this year really has proven that despite all the historic data showing that equity has outperformed commodities, if we see the data from today's point of view, commodities has really outperformed any other asset classes. And this has not happened only in 2025. This has happened if you take the data for last 3 years, 5 years, and 7 years, you will see that gold and silver has outperformed equities. So it's time that we need to debate, deliberate, and contemplate whether commodity derivatives should be treated as a hedge or it should be treated as an alternative investment class. So to discuss that, we have an elite panel, but I would like to start it with Naveen, because he has spent over 3 decades into markets, especially into commodities. What are the factors which can drive commodity derivatives for the next 3 to 5 years?
I would say that the commodities used to be an alternative asset class. Means we never looked commodities as commodities. What purpose do they serve beyond hedge? This year, or I would say the last year too, 2024 and particularly 2025, are the 2 years where the mindset of the people have shifted from equity or the other assets towards commodities too. And the factors which led to these particular interests, the time which we are seeing today over the last 2 years, we haven't seen it earlier any time. People don't used to speak about commodities. It was one of the last of the things the people would say that they want to be interested at. Since 2022, we have seen, and prior to that too, we have seen that there has been too much of an uncertainty. There has been too much of flux on the geopolitics, which has driven commodities, and as a safe haven, gold and silver particularly, has proved their mettle by giving, I think, 32% returns last calendar year. And if I'm not mistaken, gold has given returns of around 70% this year, and around 100% plus for the silver. Beyond silver, silver is an industrial metal too, but at the same time, a safe haven metal too. So the one factor which has played a very critical role on the commodity for this year and the last year is geopolitical risks. The second is the supply bottlenecks. Anytime the sanctions happen, mine disruptions happen, particularly for the metals, you see a spike in the prices. And the same case goes for the energy too, for oil and other commodities like that we have seen Black Sea event and all those things, which definitely impact the commodity price. It can be on the upside or the downside, dependent upon the demand and supply situation and the constraints. The third is the energy transition. Now, what we are seeing today is energy transition from the local kind of understanding of doing the business the way we used to do, towards solar, towards electric cars and all those things. That has also boosted the demand for the commodities, and therefore whatever the prices we are seeing. Volatility, the traders actually harp on the volatility. They love volatility. And with volatility over the last 2 years, because of many factors, like I said earlier, also been a very important factor, plus the institutional buying. If you talk about gold, silver and other products, there's a central bank buying, there's a heavy central bank buying, there's gold ETFs or silver ETFs, the inflow from the investors also coming in. We saw in India, the gold ETF figures have grown largely on the AUM. And even for the silver, as the earlier panel mentioned, 10,000 crores has become 50,000 crores today. Everything is a cocktail today for commodities, and that cocktail is giving kind of a boost to the commodity prices.
I'd like to come to Nikhil. So Nikhil has great experience on the commodities side. He runs a fund. So Nikhil, I'd like to understand from you, is the rally, or is the traction, or is the kind of return which the commodity derivatives is giving right now, is it structural or is it cyclical?
If you actually go back in history and see, what are the eureka moments for any asset class? If you go back 2020, in the case of equities, we were at 3 crore demat accounts, and then we have this COVID rally where, for last 5 years, people made almost 16-17% CAGR in equities. In mid caps, they made 25% CAGR. And the cult became so big that from 3 crore demats, you went to almost 22 crore demats. I think that same eureka moment has come for commodities in 2024. And because of which we are seeing structural shift in the way asset allocations are starting to happen. A lot of people have now become very open to multi-asset allocations. People are seeing gold and silver as a structural sort of allocation that should happen to their portfolios. And just while coming, we did some data checks as to what have been the last 1, 3, 5, 10 and 20 year CAGR returns of equity, gold and silver. And we came across very interesting data points. If you look at on a 1, 3, 5 and 20 year CAGR basis, gold and silver have outperformed equities by almost 300 to 500 basis points. Obviously, last 1 and 3 years have been aberration. But even if I look at a 20-year CAGR, equity today is close to 12.1, which mirrors very closely what the nominal GDP growth of the country has been. So you have 6-7% of real GDP growth, 4-5% inflation. On a nominal basis, we have compounded our GDP by 12%. That's where equity returns have been. Gold has been at 15.2% on a 20-year CAGR basis. Silver has been close to 14%. Now, if you look at it, the GDP growth on a nominal basis has clearly slowed down closer to 9.5%. And the advantage is because these are global commodities, you get the benefit of 3-4% rupee depreciation every year. And the fact that mined metal output is only growing by 2-3%. And if you put that in context with where the central bank buying is, out of the 4,000 crores, 4,000 tons of gold that gets produced annually, if you just look at the central bank buying number every month, that is now close to 70 tons. So almost 20 to 25% of the global gold production is getting consumed by central bank, which is pretty inelastic. If you look at the total ETF holdings of gold, 1 year back that number was close to 60 million ounce. Today that number is close to 99 million ounce. So we've seen 60-70% increase in that number also. So ETF buying is also contributing in a big way. And then obviously, you have the demand for jewelry as well. So my sense is, given the fact that your mined metal output will only grow by 1 or 2%, we should see this 15-16% CAGR growth in gold prices continuing for the foreseeable future, both gold and silver.
Now, since in India we have PMS and AIFs, who are already participating apart from FPIs. So I'd come to you, Nikhil, again. What needs to be done to increase the exchange traded commodity participation?
Look, on the AIF side, I think the participation is increasing. A lot of strategies, multi-asset strategies are getting implemented. And if you see the growth of Cat3 AIFs, that's almost a 35% CAGR that we have seen in the last 4 or 5 years. Once SIFs become more prominent, there's a special category of asset allocator in that which permits commodity derivatives even in mutual funds. So I think on those vehicles, it's very clear that we will see a lot of increase in participation.
MCX presents Institutional Commodity Investing. Media partner CNBC TV 18.
Viral, there are certain high conviction strategies which most of the AIFs are using now. If you can throw some light, which are the strategies and what needs to be changed?
First of all, Cat3 AIFs, to my mind, is a slightly tough sell when it comes to the exchange traded commodity derivatives market. And I think it's because of the tax structure, right? Because the AIF is not through a pass-through vehicle, so you end up paying almost 42.5% tax. And that, when it comes to the derivatives piece, within that also, because you can't allocate more than 10% to a single instrument, in this case, a single commodity, commodity allocation within a Cat3 AIF cannot be more than at best 10-20% or so. So it is not the most tax efficient vehicle to invest in commodities, but from an investor's perspective, because the ticket size itself is 1 crore, obviously there you're talking about sophisticated investors who would want to have slightly more meaningful strategies to be allocated in commodities, right? Some of this is legacy. It is not specific to commodity AIFs, but some of this is legacy in terms of how is that open interest calculated, right? It is one of those vehicles where you at least get a 2x leverage, but with the long short part of it, like if you are asking about strategies, what a retail investor can do currently is to have a calendar spread strategy, is to have a covered call strategy, is to have call ladder, put ladder. All of these strategies which are active on the equity derivative side could be made active on the commodity derivative side. And in fact, because of longer trading hours, because of monthly expiry that is coming into bullions right now, you are seeing a lot more adoption of these strategies, but at an individual level. And even if you are doing it in a corporate file, you will still get taxed at a lower rate at 25%. In the individual category, it could be slightly higher. But when you compare this Cat3 AIF with whatever is the industry acceptable practice, especially the US markets, where a similar vehicle would be a commodity pool operator, right? First of all, the tax regime over there is a 60-40 thing where the blended tax would come at about 26-27%. And second is, there are not so many restrictions in terms of what is the leverage, how do you categorize the leverage, which all commodities you can allocate, whether it is 10%, 25%. So although you are talking about having a sophisticated investor coming into a category 3 AIF and a professional manager running that particular scheme, I would say the field in which you operate is so regulated that there is not much product innovation that you can do, right? So it's a little bit of a misnomer that a retail investor can do a lot more in terms of all of the strategies that you mentioned about options and trying to get that additional delta of 1, 2, 3%, whatever it is based the strategies that they have. But when it comes to having a sophisticated investor, they still can't operate because of this tax inefficiencies and also because of the leverage, the way it is calculated, right? Even on the long short part of it, if I were to buy an option, I would look at the premium value, but if I sell an option, it would be considered as the full value of the notional value. So even the way the leverage is calculated is so inefficient on that part. That's my assessment.
Mudit, now currently you have for AIFs, you have an exposure which is 2x. Do you think 2x of exposure is enough?
When you look at leverage, I think there are 2 or 3 parts which are really important in terms of the leverage calculation. Part A is that if there is an institution, if there is a retail participant, if there is an accredited investor, if they go and trade themselves, they have a fair amount of leverage available to them. Now, as professionals who have been in the industry since multiple years, since over 2 decades, I think it's only fair for us to have a level playing field, for us to demonstrate what we can do with strategies on the funds that we manage. When that gets curtailed to 2x of the AUM amount, it becomes fairly restrictive and it becomes non-scalable. Just to throw some numbers out there, if you look at the total mutual fund industry size, the total mutual fund industry is at about, I think, 80 lakh crores. From 80 lakh crores, how much of that is really coming into the commodity market is the real question. Are we really seeing scale? Are we getting happy with small numbers saying that, oh wow, we're seeing the winds of change? My point is that if you can't get to scale, having a Cat3 AIF access commodity markets does not really help either us or the investors out there. Point A. Point B is, especially with respect to Cat3 funds, these are not retail vehicles. The minimum investment in a Cat3 fund is 1 crore. So you have to assume the investors who participate in this space are accredited, they are astute, they understand what they're getting into, they're not retailers. Therefore, by virtue of that, it is logical for any regulator to even consider giving a slightly higher amount of leverage, which allows some pass-through of returns back to the clients and to the investors. So I think 2x is a starting point which the regulators had put together. I think when the rules and regulations were formed, I think it's only about time that we review some of these leverage caps that had got set back in the day. I think the last point that I would want to make is that also with respect to just diversification and concentration of the fund. I think leverage is very important from a diversification standpoint as well, because the number of underlying commodities that we have that we can really deploy capital into. And when you compare that with equity markets, there's a huge skew on that. You have probably 5,000 or 6,000 equity stocks which are traded. When you compare that with commodities, you probably have 10 or 11 really liquid commodity contracts where capital can be absorbed. So, having a 2x leverage caps literally, forces us to operate with one hand tied behind our back. So it's probably a good time to kind of review some of those constraints that had been put forward when these regulations got established.
So on the same line, if you mentioned about the leverage, I'd also like to understand from you on the concentration risk. So what's your thoughts on that? Is it fair to have the same kind of comparison with equities, or you have any other views on it?
I mean, very similar thoughts, to be honest. I mean, honestly, the 10% concentration cap is effectively very difficult for any Cat 3 fund to operate. Like I said, you have 10, 11 commodities that are liquid where you can absorb capital. Now, when you operate with a 10% cap, it is highly impossible that you get an opportunity of a particular strategy across every single commodity at all points in times. And by virtue of that, having a 10% cap is fairly restrictive. It makes deployment of capital difficult. It makes generation of return a lot more difficult. So like I said, I think some of these regulations that got set back in the day, it's probably a good time to go back and just review some of these norms that had got set a few years ago.
So Akshat, you run multi-asset fund. What are the risk controls you expect in case you need to expand and bring commodity derivatives into part of your asset allocation?
Jayaprakash, in terms of when we look at a multi-asset PMS structure, right, which is what we run, commodities being inherently a derivatives-oriented play, by which I mean that unlike equities, bonds, or even REITs for that matter, inherently to take investment exposure to commodities, you have to be in the derivative route. You cannot kind of get into physical commodities as easily. Some of the checks and balances that we would typically like to incorporate and also kind of see more regulatory traction on. I think one is obviously in terms of the different margins that are kind of in place. There needs to be a sufficient buffer which is kept for that. I think custodians anyways would insist on having 100% of the margin requirements met, but it can be over and above that. Philosophically speaking, of course, in case of PMSs, the regulator does not want any sort of leverage or borrowing to be done. So essentially the margining anyways has to be done upfront 100% in that sense. The other important part, of course, is in terms of making sure that to the maximum extent possible, exposure is taken in cash settled derivatives. If at all any physical settlement derivatives are entered into, the idea would be to make sure there is a foolproof mechanism to square it off, because we are basically portfolio managers in that sense. We have no expertise in managing physical deliveries. That is not the intention in any case. The intention is to ensure that there is portfolio diversification for the clients. So that is something which is top of our mind. And I think in that context, the one interesting development which I am at least observing or watching for is how well the index derivatives that have been introduced by MCX also kind of pick up, because there it is, those are by definition cash settled, and they probably mirror more of the macro and broader level asset diversification which many sophisticated investors would look for. So that is also something which is going to be interesting. Lastly, I think there is a slight dichotomy in terms of risk management when it comes to PMSs specifically. So as we may all be aware, PMSs are not pooled vehicles in that sense. Every client has a unique portfolio. So in terms of the client level P&L and positions, essentially those have to be done at an individual level in that sense. But operationally, it becomes that much more of a challenge. So we probably need to see more clarity and steps being taken in terms of having a fair trade allocation pooling mechanism for the execution, but at the same time making all the client accounts are segregated.
You have spent almost 2 decades, right, into investing, especially on the equity side. So to understand your point of view, how commodity derivatives enhance alternative portfolio resilience?
I think in last 1 year, the perception has changed a lot. We, like almost most of our clients, the institutional clients also, they're asking for, exposure in commodities, especially gold and silver. So from being, kept in a safe, these commodities have actually taken the center stage. And now everybody wants to have a little pie on gold and silver. Now the question is how to hedge. Because like equity, people hedge with, derivative instruments. On the commodity side, the problem that I think we are facing is that it's not cash settled, the gold and silver. And which I would say for the investment piece, that is taking the major chunk. Nobody is investing in crude or natural gas. It's cash settled, it's, just being traded.
What derivative instruments you think are most practical for alternative investments?
Practical aspect, if we see for the derivative, commodity derivative instruments, I think it's a watershed moment for commodity industry per se in India. And there is a great, I would say the timing is correct. If MCX can launch a broad-based commodity index and then launch a weekly options on that, probably it will strike a chord with people. Like how we have seen on an SC and BSE, there were 7 weekly indices that were being traded. But ultimately, because there was so much chaos, that 5 were suspended and 2 are still there. But they are benchmark indices. So similarly, on those lines, if MCX can, launch a broad-based commodity index, cash settled, weekly options, that will probably give it a, take off for the entire commodity space. Because once you have one product that is very liquid on the option side, other products also catch up. Right now, I think there are 2-3 sectoral indices which are cash settled, but unfortunately there are not much volumes or probably very, very low volumes.
The consensus has been there is no doubt that commodity cannot be an alternative investment. Thank you everyone for sharing your insights.
MCX presents Institutional Commodity Investing. Media partner CNBC TV 18.